Hi, and welcome back to Channel 11. Today is Tuesday, March 4th. Some volatility in the markets. Big sell-off the last couple days in the equity markets. CNBC is freaking out and bonds are rallying. So let's take a look at what's going on. Land of Gains is giving back much of its gains. The rocket ship is a sad face. It's been going down. We broke through the 200-day moving average at one point intraday today. We bounced off that. Looked like it was going to be a rally into the close, and we sold off into the close after that brief rally in equity markets. So what's been going on out there? Well, there's been a massive change in sentiment around growth. There was all these high expectations of growth, excitement about a rebound and reacceleration of the economy with the new administration and policies they would put into place. But the data, which is obviously backwards looking and has nothing really to do with near-term policy, has been coming in weaker than expected. So here's the City Surprise Index. We haven't looked at this in a couple months, but we can see that that hasn't been surprising to the upside. In fact, we've been getting some downside surprises, and with that, rates have been coming down. We just got some updated data coming into Atlanta GDP Now forecast. Coming in now at negative 2.8% for Q1. A caveat here is that a lot of this has to do with how this forecast is calculated, and there's a lot of front loading of imports coming in with businesses worried about tariffs. They're purchasing goods they need for their businesses, and that front loading is taking that GDP Now down in negative territory. This, I think, as more data comes in, could smooth out. And so I wouldn't read too much into this, but this, again, one of the reasons that rates have been coming down and risk markets have been selling off. Another way to look at that big spike in imports is the trade balance. You can see this big collapse down here in the trade balance has to do with that front loading of imports. Big rotation out of Mag 7. You can see Mag 7's been suffering here. We're going to see this more in detail as we go look at the different subsectors of the market. And that theme that we've been talking about, liking here at DoubleLine equal weight more so than the market value weight. You can see market value weight really underperforming equal weight. So that with those high flyers coming down, that equal weight has been doing better. Also, we've been watching the speculation out there, the speculative fervor collapsing. We looked at this last couple months, and it kind of continues. Bitcoin, I guess, on this short time frame doesn't look that bad. But things like Dogecoin, ARK, Tesla, all having some big reversals off their exponential charts that we saw over the last couple months. AI, looking at semiconductors, are we past the peak AI frenzy? Again, this continues to weaken, so we'll keep an eye on this as well. Trump trade reversals, another theme that we've been talking about. It was off to the races for small caps, for financials with deregulation. They were going to push inflation higher, so rates went higher to start the year. And the dollar was getting stronger with rates higher. With a 10-year reversal in yields falling, that's brought the dollar down with it. Financials have been really the only one kind of hanging in there. Small caps have gotten hit. And now financials finally, can't keep away from the beta of the market with the sell-off in broad equities. Financials starting to get hit a little bit, but obviously, as you can see by the chart in the bottom left, still doing better than these other sectors. Equity performance, this is now looking across both developed markets, Europe on the left, one of the best places to be. And then on the right-hand side, you can see small caps, tech, the laggards, EM kind of flat on the year. So I guess not the worst place to be, but it's really been all about Europe and that make Europe great again or mega trade that's been coming into fruition. Here's another look at the different international equities and local currency. And it's really the European stocks that have been on fire. UK in the top right, Euro Stock 60 in the bottom right, EM kind of going sideways as we just saw. And Japan kind of struggling here with inflation picking up and rates kind of staying high, and perhaps they have to hike rates there. And so that's been one of the issues over there in Japan. But I do think valuations still look interesting in Japan, and I think in the longer run, it could be a good place to find some opportunities. The mega make Europe great again. Another way to look at it. This is the S&P versus the MSCI Europe Index, you can see that massive outperformance started in 2023, went through all of 2024 into the beginning of 2025, and this is huge reversal as U.S. equities come down and European equities do well. We're off very high levels on the S&P, so I'm not really surprised here. But there's been a lot of times when we've thought that Europe's been the place to be, and it kept reversing, and the U.S. kept catching up. So is this time different? We'll have to wait and see. One of the things with the European indices is they just don't have as much tech as we do. So it's much more industrial focused over there than it is in the U.S. This is just an amazing chart. This shows you the euro after the first Trump election, how it sold off into the election and then started rallying again. It almost looks identical. So keep an eye on this, because with weakened foreign currencies like the euro, if it could be a tailwind for your returns, with the equity indices posting positive price return and then also making some money on the local currency appreciation relative to the dollar as well. Looking at the yen, it's off its cheaps, got all the way back up to that 155 area. Now we're sitting about 148. And with Japan on hold on cutting because of inflation and perhaps rates coming down in the US, you might see a continued rally in the yen. Commodities off their local highs, along with the growth scare that's coming with, that's bringing the equity market down. I think that's also pressuring commodities. So everything's kind of, flat to sideways, except natural gas, of course. Probably has to do with seasonality there with cold weather. But gold, look at gold. Precious metals up 9+%. One of the best performing assets out there this year is gold, which is amazing after the run last year. And I think it has to do with, with so much uncertainty and fears of tariffs and global uncertainty. It's just a new place to go that you don't have to deal with all the currency volatility that's out there. Interest rates, it's been a wild ride. But if you go back about 2.5 years to the summer of 2023, it's like nothing happened. The 5 and 10 year are almost the same. The 2 years down. The long bonds up a little bit, but it's just been a wild ride. Kind of that, call it 470, 480 level on the 10 year recently, got up all the way to 5 in 2023. And it's had trouble breaking that 380 level. Here we sit today in the low 4s. I think the market's maybe a little bit overbought on the bond side. We got the 2 year at one point down to, I think, a 380 handle today. And, I think that stocks are probably going to bounce off the 200-day moving average. We've got extreme negative sentiment. If you look at the AII investor survey, usually when sentiment is so bearish on stocks, stocks are down 10+%, 10-20%. I know we're only down 5, but the sentiment is so bearish, I almost feel like it's time for a little bit of a bounce here. And if equities bounce, I think rates bounce with it too. It's just been an amazing whipsaw of higher for longer. No, the Fed's going to cut higher for longer. No, the Fed's going to cut higher for longer. No, the Fed's going to cut over the last couple of years. So, if that jobs report this weekend on Friday comes in pretty good, that could be something that would reverses fixed income and maybe gives some tailwinds to equities again. So let's see what happened in Feb. Good month for bonds. It was a challenging couple of years for high quality fixed income. It's credit, deep credit has been the place to be. The riskier the credit, the better. Floating rate credit like bank loans and CLOs have done really well. But as we finally get a bond rally here, you're seeing, at least in February, the far left of this chart, these are high quality parts of the fixed income market: Treasuries, agency mortgages. In the middle, in the beige, investment grade corporate bonds up 2%. The aggregate index up 2.2%, bringing year-to-date returns. Agency mortgages finally, after years and years of underperforming Treasuries and corporate bonds during this sell-off of the last couple of years, they're from the cheap valuations that we've noted here on Channel 11, agency mortgages being cheap, and now it's time for them to shine. So agency MBS, top performer in the high-quality fixed income category, up 3.1%. Versus corporate bonds up 2.6, Treasuries up 2.7. So make mortgages great again is something we joke about here as well. The curve, we've had a steepener on in many of our strategies that continues to work in the long run. It's obviously a volatile ride with the markets, but even today, the front end of the curve was down, the long bond was down about a point. What a dramatic change from the beginning of the year in Fed funds. We went from December 31st of last year, I think the market was pricing in around 1 3/4 cut through the end of the year. At one point that got down to almost just 1 cut through the end of the year, this year, 2025. And now at one point today in the height of the bond rally, the market was pricing in 3 cuts. So a big change in sentiment around growth, worries about tariffs. You had the last services, ISM services come in weaker than expected, although still above 50. You had retail sales in January come in weaker than expected. Part of that could be due to LA wildfires. Part of that could be due to cold weather around this time of the year. But we've got some new ISM services data coming out later this week. We've got some more retail sales in the following weeks, and that should get us insight into the spending on the consumer side. And then the jobs reports are going to really give us an idea of what the labor market's doing. So I think these job reports are going to be really important in the coming weeks and months. Inflation expectations, they spiked higher because of all the tariff talk. And so you can see the 2-year break-evens pushing higher. But with rates coming down and growth fears, you're going to start seeing some of these break-evens turn over, I think. But with the rally in bonds, real yields not looking as good as they did. We got all the way up to north of 2%, real yield for the long end of the curve. On the front end, the real yield based on short-term inflation expectations is basically 0. So not looking as good as it used to on that front end of the curve. Spreads are a mixed bag. With equity volatility, we've seen spreads start to widen. Part of this has to do with the rate move has been so violent and quick that there's a lot of buyers that are yield buyers that, they're insurance companies. They said, okay, if I can buy a single A bond at a 5.5% yield, that's pretty good. And but when rates fall, 30, 40 basis points, all of a sudden that 5.5 yield becomes a low 5 yield, or that 5 yield becomes a 4.5 yield. And they start boycotting and saying, I think this rate move could reverse. So why don't I widen the spread that I want to buy this asset at? And I want to buy yesterday's yield. So yields are kind of unchanged, all-in yields, but with the base rates lower, credit spreads have definitely widened on that front. You can see that they're almost wider in every sector except agency MBS, make MBS great again, and CMBS BBB minus, but we don't see too many of that trade, so I would take that spread tightening with a grain of salt. We definitely see high quality fixed income out about 5 to 10 basis points. As you go down the capital structure, out a little bit more, high yields out about 25 basis points from its tights. Here you can see IG it got sub 80, now it's about 88, so a little bit of spread widening there. High yield, I think at one point got to around 250 spread, and we got about 30-ish plus basis points of spread tightening on high yield. And now my favorite chart, the what looks cheap report. The dots are moving up. It's not as bad as it was a week ago when you had investment grade corporate bonds at first percentile, high yield at first percentile. Still not looking screaming cheap, but at least we're getting a little bit of softness in the credit markets. Top left, you can see all sorts of mortgages looking cheaper. We added legacy RMBS, which are those bonds made before the global financial crisis. There's still some out there, and that's also one of the cheaper parts of the market. We wanted to add that in there because there's been some questions about it. So good luck out there. It's been a volatile couple days, but stay calm, stay patient, and keep some dry powder for opportunities.